Good morning, everyone. Hope you're having a wonderful weekend. It's Saturday, July 13th, and JJ here from Micro E Futures and Equities ETC. Want to give you a quick breakdown of what happened this week, especially the last couple of days of the week were very confusing to traders. And unfortunately, I heard of a lot of people, having difficulty and taking some pretty big losses from what I saw that was mentioned, on financial Twitter stuff. So let me go through what happened. And it's always good to look at a market after the fact to see what has happened because it's going to help you set up for what's to come. Okay. Now, we were lucky in our trading room and in our coaching room where we do one on one lifetime coaching. Um, we were very lucky because the market gave us a very, very clear indication that the sell off on Thursday wasn't going to have any continuation downwards. Okay. And this is a little trick that I learned from the market profile folks, and we're very grateful to them for the work that they did. And let me show you what's going on here. Now, even though most of you don't realize it, you are inventory traders. Um, Even though you might be moving average traders or RSI traders, um, but even though you don't realize it, you guys are trading against the accumulation and distribution of inventory by size players. It's very simple. Markets are also taken up to sell once it's established that size has control of supply. I'm going to repeat that. Markets are taken up so they can sell. Because when you take a market up, you attract buyers. The more buyers you attract, the more volume you can sell into that buying. Now, most retail traders have never had to sell a million shares of stock or buy a million shares of stock, whether it's for themselves or for a client. So they don't understand the mechanics of order flow and why price moves. I see a lot of stuff on Twitter, and it's just complete misinformation of how market makers doing this, market makers doing that. Let's go take a quick look, break it down, and then what we're going to do is we're going to give you a way to prepare so you can trade using a repeatable, common sense trading setup that is scalable in time and size and also practices savage risk management because, hey, I don't like losing money because I don't have a money tree in my backyard. So, and if you do, let me know where you live. So let's get to it. Anyway, we've had straight since the July holiday, since the 4th, we've been moving up. This is called one time framing up or trend up, where every low is higher, is successively higher. Now, the reason why the lows are getting successively higher, excuse me, is because the bid is chasing the offer up because supply, which has been locked up here, is reduced, and the people who own the supply are increasing price and the buyers are following. That's why you'll get a trend line up. Okay. Then what happened on Thursday was we broke trend. We took out the low of the previous day, right? But there were a couple of things that happened on Thursday that were very beneficial in us being able to go long on Friday, right? One was the shape of this profile. If you look at it, looks like a funny looking letter B. The market profile folks call this a liquidation profile. It's kind of, it's a profile that is created from the liquidation of traders and the accumulation by short sellers and wholesalers because shorts are coming in and covering, wholesalers are building a position on top of them, then comes retail and all of the rest of that stuff. But the order of buying when a market falls is number one, the short sellers come in to buy. They're the first people through the door because they're closing a trade, they are cutting risk, or they are cleaning up their blotter, as we used to say in the old days. So they're closing positions. They're first in the door. It's a risk-free transaction to close a position. They're not initiating. So what happens is the short sellers come in, and then the wholesalers recognize that and then build a position on top of them because they know that we can leverage them. And if we just stop selling here, the price won't go any lower. Now, what that does is it leaves a thing called a poor low, and we'll show that on the next slide. The overnight, same thing. The overnight could not take out that poor low until the news came, and we had a quick, rapid flush down and move back up. Here's the beautiful thing about market profile. If you use market profile, you can see, hey, check it out. How much time did we spend underneath 56.33 and how much time did we spend above it? Really quickly, you can see that all of the time and volume is traded above that. That's a quick flush, a look below and fail. And then what happened was we caught people getting short down here. Instead of closing their short, we have people who always initiate because people follow price. Following price is very, very dangerous. Okay? Following price is the most dangerous thing to do. We observe how price reacts. We don't follow it blindly. So when people miss the short and they initiate down here, when the volume, those sell orders dry up, the market rips back up looking for supply, they get caught short and they help that move back up to the upside. Because I can bet you anything that people were shorting down here yesterday, thinking that we were going to break 5,600, which did not happen because the poor low held. Number two, when the market opened the next day, the low here didn't get anywhere near the previous day low, nor could it get anywhere near the cost basis. This is your inventory, ladies and gentlemen. This is the cost basis of the liquidating traders being accumulated here. What are you going to do once you have inventory? You buy 10 cases of oranges. You pay $5 per case, for example, and then you got to make a profit, right? So you want to sell them at higher prices. It's a market. Remember, it's still a market. No matter how much fancy language and BS they throw at you, it's still a market. The objective of a market is to distribute inventory for profit. Make no mistake. Okay. So inventory is acquired, little flush to clean it out, right back up. Okay. Now, what happened on Friday? Everybody was like, oh my God, it's a trend day. It's going to keep going. Well, we hit the new high, put in a new RTH high, and then the market liquidated because most of this buying was created by short sellers. Now, these people, as soon as they see somebody willing to sell at a cheaper price, they'll drop their buy orders. And that's what happened in M period, and they dropped their buy orders all the way down. Now, if you don't believe that you're inventory traders, I'm going to show you something. Here is the value area from Thursday. That's the value area high, the high of the cost basis. Here's the value area from Friday. You will see, and I'll tell you something, there's no such thing as coincidence in finance. We stopped selling, what a coincidence, right back when we got to the top of the previous day's cost basis. Ladies and gentlemen, you are inventory traders. Learn how inventory moves and then build a repeatable setup around the movement of that inventory. That's what we do at Micro E Futures, right? Before I'm done, I'm going to take you and show you what a poor low looks like. Here, you could see the letters of the market profile. I'm just going to make this bigger. Apologies. If you look at the market profile, you will see that these two letters from Thursday line up exactly. The I period and the J period. That's called a poor low. To have a proper low, you need at least 2 ticks of excess according to Mr. Dalton and Mr. Saddlemeyer. That is a proper low. That is a poor low. A poor low just means that at that particular price level, right, when we got down to 56.30, there was a massive competition to buy, which inhibited the market from going lower. The reason, and combined with that, is a lack of supply. Because when you get right down to the cost basis of previous days, you stop selling, right? Pretty cool, huh? So what happened was a lot of shorts came into cover. Then once the shorts started to cover, right, the size wholesale traders started to build positions above them, right? Building positions, and then selling them off at a beautiful, handsome profit on Friday. Okay? These markets, ladies and gentlemen, all involve the distribution of inventory. Inventory is acquired at a cheap price, distributed at a higher price, sold back down to the acquired price when buying runs out because you have to capture the buying. Something else I'm going to leave you with before we leave. I've seen some really, really crazy stuff on Twitter about why markets liquidate. There's a reason why markets liquidate. The reason is when we take this inventory here and we sell it to you all the way up, eventually people tire from buying. And the people who have bought, now they're trapped because these aren't investors. These are day traders. Some of them might be trading with a massive amount of money, but they're still trading in a short time frame. So what happens is once we've sold a bunch of this, we sell it all the way up, but up here, it kind of goes sideways for a little bit, and then it breaks. Okay. It breaks because the people that we've sold it to start to sell. When they start to sell, the people who own product underneath 56, 54, they sell in front of them. They step in front of them. Because if you own product under 56, 54, you could sell it all the way back down to the top of your cost basis and still be in profit. While the people that you've sold it to here are throwing it out the window as fast as they can because they got to get out of the position before the market closes, right? So the large traders step in front, the traders who act as wholesalers, they knock the market down. Why? Because there's buying here, right? And they want to capture that buying before the trapped longs do. It is your job, it behooves you to sell your inventory. There's no reason acquiring inventory if you hold on to it, because that just ties up capital, right? And a smart business person turns their inventory into capital as quickly as they can and keeps repeating that process. That's why cash flow comes in, right? Turning inventory into cash. So the large traders undercut the trapped longs. This causes price competition down. The short sellers who are trapped, who have their bids here, once they see that happening, they run for the hills. So eventually what happens is we come down to the cost basis of the previous day. The market stops on a dime because these large sellers just stop selling. And if you ever heard people say defending price by buying, that is the biggest lie in the world. The quickest way to the poorhouse is to defend price by being on the bid. The way large traders defend price is you stop selling. And eventually what happens is if you stop selling, and we're all trained to think the same way, right? There's only one way to trade institutionally, right? We're all trained the same way. We just stop selling there, and then everyone just throws up. The shorts come in and cover, and the market closes around here. So going forward this week, here are some levels: 56.64, 56.54. You know our cost base is under 54. We might come down in that Sunday night. The big level that you need to watch out for are these swing lows, ladies and gentlemen, right? The swing lows are here at 56.15-ish. And then the next big one is down here, okay? And that's close to my 55.84. That's a big level. Until then, we could distribute inventory here because cost basis on the longer term chart is underneath us. Let me repeat that. The cost basis on the longer term chart is underneath 55.84. So longer term, If any one of these traders or groups of traders are long huge down here, they can sell the market down to 84 and still be in profit. Okay. If you want to learn how this all works, and if you want to learn how to trade it and how to build a repeatable business setup that makes common sense, it's not, there's no math or anything there. There's the distribution of inventory. All we're doing is we're teaching you how to repeat a process that makes common sense in a business sense, right? Which is scalable. So you can start small and using the same techniques, build your trading size as you build experience, right? So you can scale up the trades that we teach you in time, so you can hold them longer. You can scale them up also in size. So they're scalable in time and size. And the risk is very manageable. We don't give back a lot of money in this room, right? Take what you can, give nothing back. That's our motto. Okay. Please come visit us at microefutures.com. I'm JJ. I hope you're having a wonderful, wonderful weekend, and we'll see you all next week. It's going to be a very interesting trading summer. And thank you so much for listening. Bye for now.